Partner, CNBC contributor Tom Lee. Tom, good morning. Thanks for being with us. Markets are down today, and we're more than 1,000 points from your target made back in August of 4,800 on the S&P by year end. Have you turned more cautious or scaled that back or pushed it out?
Well, it's certainly a lot further away than it was in August. In the last couple of weeks, I think the market is trying to discount what is a much more hawkish and I think more forceful Fed path to try to contain inflation, one where they're losing a little bit of patience. But the reason I still think we still want to think about stocks doing pretty well into year end is that it's ultimately going to be coming down to the path of inflation. And if inflation starts to improve sharply, which a lot of leading indicators show that, I think markets are going to start to look at the Fed's current path as sufficient to actually contain inflation. And I think that's going to allow risk assets to rally. So I would say the bar is definitely higher, and it's been a really very tough few weeks, especially post-Jackson Hole. Mm-hmm. But I rule out the probability that stocks rally pretty strongly into year end.
So if they do rally, if the S&P gets back to 4,800, even next year at some point, what is the valuation behind that call, particularly for tech, which makes up so much of the broader market? How are you valuing that sector? Does it ever come back to those 2021 peaks?
Yeah, it's interesting timing that you're asking that question. I just got off the phone with a tech CEO, and one of the things that investors need to keep in mind is tech companies really got cautious early this year because there was a lot of signaling about monetary tightening and the risks of inflation. So companies aren't necessarily tripping over their skis right now. But more importantly, when tech companies are looking at their OPEX and the potential for a soft landing or even a recession, recessionary business conditions, they've got a lot of room to cut costs. So I think we may be surprised by the profit margin expansion of tech companies even in a tougher revenue environment. So that means that there could be earnings surprise on tech. So I think there's a reason why earnings revisions haven't dropped as much as they should have done by the end of this quarter, right? We're in the confession period now for earnings. And I think part of that is that companies really were pretty good at managing costs because of the signaling of the weakening economy.
It's such an important point, Tom. As you're talking, I was reading this Bernstein note on Meta, and they say the reality is the company has a lot of room to preserve earnings power via sizable OPEX cuts and protect the EPS floor that the bulls are counting on. Would you argue that Meta is indicative of broad and in aggregate corporate America's power to cut costs?
Yes, and especially when you think about the environment, Carl, over the last 10 years, companies had a decent top-line environment in a weak inflation environment. So they had not a lot of nominal growth, but they were focused on growth. Now that we've got better nominal growth and companies focused away from top line, that is giving them ample opportunity to really tackle OPEX, as you're pointing out. And ironically, or sort of maybe in favor of the Fed, in tech, a lot of the OPEX is going to be labor. So I think you're going to see job cuts coming in tech, and that's really going to help preserve earnings power. But that actually works towards the Fed's goal of trying to manage a very tight labor market.
Yeah, we certainly already have seen some of those cuts. Tom, while we have you, I just want to get your view on Bitcoin. The link between Bitcoin and equities, particularly tech stocks, has been growing closer once again. That comes amid that more uncertain backdrop, inflation, and the Ether merge, which was billed as one of the most important events in crypto's history. How do you explain that? Are you still as bullish on Bitcoin as you have been?
Yes. I mean, I think one way to really understand the link between Bitcoin and tech is that they're both really plays on fintech, the sort of innovation around financial services and products, and whether you call it DeFi or fintech. And so as NASDAQ's gone down and the risk of capital availability is down, that's why it does hurt crypto. The ETH merge, I think, was pretty successful. It's going to take some time for the supply benefits to show up. But I would say, again, I think crypto's holding up pretty well. I mean, we're talking about markets typically expecting Bitcoin to have fallen further because NASDAQ's down 27%. I mean, I just think Bitcoin holding above its 2017 highs is actually quite constructive.
Right. We're just looking at a chart just below 19K at the moment. Tom Lee, thanks for being with us. Talk to you again soon.